Morning, everyone. Welcome to the Hinrich Foundation Book Talk. We're having this book talk today with Dinny McMahon, who's head of China and markets research for Trivium, based in Chicago. Hence the timing of today's talk. I'm Chun Yap. I am research director for the Hinrich Foundation. We are a philanthropy that is dedicated to the mission of advancing global trade. We have two programs. One is education and one is research. And this book talk series is a collaboration of both our programs. I wanted to introduce Dinny, who is a longtime friend of mine. Dinny wrote a book. It's been a while now. It's called The Great Wall of Debt, China's Great Wall of Debt. He wrote it at a time, 2018, toward the end of his well-starred career at the Wall Street Journal, where he was a finance correspondent based in Beijing and Shanghai. In the Wall Street Journal, for people who know, when you're called a finance correspondent, what it really is that you're a correspondent for everything. So it was banking, it was finance, it was macroeconomics, it was like whatever. And then he had this way of just he seemed to like cities with nobody in it. Which I'll let him tell you more about. At the Hinrich Foundation, we cover trade, obviously, and we look at FDI, we look at geopolitics, digital trade, sustainable, as well as trade policy. Of course, a central character in all of this is China. So today, we're going to be talking to Dinny about China's economy. Its latest 5-year plan kicks off this year. Robotics is actually a huge focus on it. Dinny has addressed some of it in a paper that he wrote for us, which was on the changing nature of China's exports. There's an export surge coming from China. Dinny also addresses some of that in the paper that he wrote for the Hinrich Foundation. And we also want to talk about China's structural weaknesses, its struggle with consumption, and the subject of Dinny's book, which was its debt-fueled investments, leading to China's ambitions in a global order, how that has changed with geopolitics and challenges to multilateral trade. But first, back to Dinny's book. Dinny's book, if for those of you who haven't read it, opens with this beautiful description of Borobudur, which is I've never been to. I mean, Dinny obviously has. He's Australian, by the way, but I also want to start at the end, and I hope Dinny will talk a bit about Borobudur both, where he closes with a place perhaps just as remote to some of us, Bridestow, Tasmania, where he met a family called the Ravenses, and tells an anecdote of how their lavender teddy bears called Bobby became really a symbol for China's market. It's huge, the allure and potential of its huge consumption. Well, sorry, / huge. And really, the comment that it makes on income issues in China, public expectations, which is something that nobody really talks about very much, and a social contract between the Chinese state and the Chinese people. But Dinny, I'm not going to hog the microphone very much anymore. I'm going to turn it over to you. Thank you so much for being with us this morning, or this evening for you, in Chicago.
No, not at all. It's fantastic to be here, Chiun. I was very excited when you invited me.
No, we're very glad to have you. It's I've been a big admirer of your work, even back in the journal. So tell us about Borobudur. Well, tell us about yourself, how you got to write the book. What made you write the book? And as you very kindly offered, during it's your thoughts on how things have changed since, and what China was and is today.
Hmm. Oh, there's two kind of reasons or two arcs that sort of explain why I wrote the book. The first was on one level, the book was an incredibly cathartic experience. I mean, during that period that we were at the journal, I mean, at Dow Jones for me and the journal, I mean, I spent 10 years working as a financial journalist in China from 2005 to 2015. You look back at that now, that period, that decade-long period, and it was a golden era. I mean, in terms of, I remember when I first started, it almost felt like it didn't really matter what you were doing in China. You just felt as though you were at the center of history. I
Yeah.
mean, it was just instinctive. It was visceral. And you look back now, and that really was a golden age to be living in China as a foreigner, in terms of the experience, in terms of the pace of economic growth, and I think also in terms of the potential of what China could become and would become. It seemed both open-ended and preordained at the same time. The future was bright, if nothing else. And so I wrote the book for a couple of reasons. One is because as a journalist at that time, I mean, look, it was fantastic writing for the journal, but also one of the great frustrations is that you never got to write more than 2,000 words. A generation before us could sort of go out to the countryside and come back with like a 5,000 word,
Yeah. Yeah.
magnum
Only to
opus.
go, no, cut that, cut this, cut this. Yeah.
So we had so much. Sometimes some of our best material was left on the cutting room floor.
So
And
much.
so too much. And so after a decade, it was kind of one, I had all this material, but there was also a sense of what you were saying before. We end up covering so many disparate, seemingly unrelated stories. But after a decade, I kind of felt that there was a sinew, there was a something connecting them all. And in some ways, that was kind of what led me to writing stories about ghost cities, about overcapacity, about efforts to break down industrial monopolies. They all seem to be linked on a certain level, but we never really had the bandwidth to kind of pull the thread and work out how they were connected. So on one level, writing the book was a cathartic experience because it gave me the opportunity to sit back and try and work out what the broader overarching narrative was here. And of course, part of it as well as, after that amount of time in China, your notebook is sort of filled with these absurdities of how the Chinese economy actually works from the ground up. This situation where, policy is imposed top down, and yet the way that it's imposed, the way that it's implemented, or the way that it's twisted, or the way that it's sort of, people get around it at a local level. It's a sort of thing that's difficult to write about. It doesn't really turn up in the mainstream coverage of how China's economy works. And so on one level, there was this sort of urge just to kind of get that out there. It's like, the working of this massive economy is so much more complicated than you really appreciate when you're kind of sitting on the outside. So that's kind of the first reason I wrote the book. But there's also kind of a longer arc to how I ended up writing this thing. And it really relates to what you were saying about
And he
Parabadu.
arrived in China which year?
Well, as a journalist, I started working in 2005, but
Right.
I'd already been there studying for a
Um,
year. I was a foreign student there in 97. I was there again as a student in 2001. So by the time I started working, I'd already studied there for 3 years. But the other reason I wrote this, as I said, relates to Parabadu, is I had my first Chinese lesson when I was 10 years old, or about 10 years old, which is not unusual anymore in Australia, but at the time was incredibly unusual. And it was because my dad had spent most of his career, well, he spent his entire career working for Australian mining companies and Rio Tinto in particular. And by the time I was born, like before I was born, he worked on mine sites, he managed mines, he built Parabadu in Western Australia. It was
So before that, we should explain to the listeners what Rio Tinto is. They might not know.
of course, sort of Rio Tinto being one of the two big, I guess, Anglo-Australian mining companies, along with BHP. They're most known for iron ore, but at this point, it's very much a diversified, mining company. But Parabadu, which is, my dad worked back in the 1970s, sort of built the mine from the ground up, was an iron ore mine. And so by the time I was born, my dad was working in head office and was traveling around the world a lot. And in his experience, and this was in the late 1970s, oh, sorry, by now it was in the early 1980s, he was sort of finding that as he traveled around the world, he was coming across Chinese buyers more and more often. And of course, at this point, they were always state-owned firms. But of course, this was a time where, the sort of number two global economy was Japan. Anybody in Australia who was learning a second language was learning Japanese. And dad came home one day and said, "You're going to learn a second language. Everybody else is learning Japanese." Actually, what he said is the Japanese speak English, and that you should learn Chinese. And
Wow.
that set me on a path. I studied Chinese all throughout high school. I finished high school. I went over to Beijing studying for a year, and then through my degree, I went back again. I finished my degree. I went back again, and then I started working as a journalist. And so, in some ways, writing the book was kind of the culmination of kind of almost a lifetime of trying to learn about China, struggling with the language, and just trying to work out its place in my own life. And in the end, what we ended up with was China's Great Wall of Debt.
Right. And for anyone tuning in, let me tell you, you weren't struggling with Chinese. I mean, Dinny's Chinese in some respects, particularly with policies, is better than mine. I mean, he's just one of the most fluent Chinese speakers that I know, and it was always sort of jarring to me to hear you open your mouth and speak Chinese, and then and then to look at the expressions of the locals around. But let's circle back to the Ravenses in Tassie, and what this says about consumption then and consumption now in China.
Yeah, that was, it was a fascinating story. I mean, when Xi Jinping visited Australia back when, God, was it 2013? I can't remember what year, but he went to Tasmania, right? And it's mind-blowing to think that the leader of China, like, no offense to Tasmania, beautiful part of the world, but it is, it's not particularly economically significant. It's very small. And the idea that the president of China should turn up to Hobart Airport is, it's a little bit off the beaten track to put it mildly. And when he arrived there, he was presented with a lavender stuffed teddy bear from this farm. It was an absolutely a phenomenon. Um, and I think what I found fascinating at the time, well, probably more with hindsight, just trying to work out why this thing was so popular. Because, the Ravenses who ran this farm, they were like, look, this is an affordable luxury. But on one level, I mean, these bears were really expensive. People were buying and selling them on Taobao. It was a few $100s. I think it even got well beyond that at some point. And so
$100,
it was, yeah,
unbelievable.
it was.
The lavender
These things
stuffed
weren't
teddy
cheap.
bears.
Yeah. These things weren't cheap at the end of the day. And I think it was less about it being an affordable luxury. And I think we went through a period, particularly in that golden era that I was talking about, where not only were incomes rising in China, but you know, you had a relatively strong renminbi, which I think in some ways acted as a subsidy for China's middle class. Now, of course, it could have been stronger, but it was the strongest it had ever been. And you had this situation where it wasn't just people going to Australia and buying lavender stuffed teddy bears. You had this wave of Chinese people, increasing numbers going to study abroad in Australia, the United States, the UK. More and more people were taking international holidays. When they took international holidays, they would take, a second suitcase, and depending on where they were going, they would buy up big consumer goods. It would be sort of children's clothing in the United States. It would be luxury goods in Europe. It would be electronic goods in Japan. It'd be cosmetics in South Korea. But there was this moment in time where people were traveling, they were going abroad, and they were buying stuff while they were abroad. It wasn't isolated. And I think these days we look at China and we see how much of a challenge getting consumption growth to even get up to the pace of economic growth is. I mean, consumption growth has lagged since the housing market has peaked. And I think one element of that is the middle class in particular has seen their wealth massively eroded by the collapse in housing prices.
Right.
But I think it also has something to do with the currency because people no longer find it cheap to go to the United States to have a holiday. And
Mm.
although the renminbi has, weakened a little bit, it hasn't weakened that much. But since COVID, you had this, sort of divergence in prices between the United States and China. So it doesn't necessarily show up in the exchange rate, but it does turn up in the lived experience of people paying at the cashier in both of those countries. So whereas in China, we've had effectively deflation or minimal consumer price inflation. In the United States and everywhere else in the world, prices went up, and of course, incomes went up, if not accordingly, but more or less in as prices went up, and that that divergence has meant that it's no longer cheap for the China's middle class to go abroad and do what they were doing a decade ago. It no longer is something that they can't sort of fly to Tasmania and go to Australia, deliberately go to Tasmania to visit a lavender farm to buy up on the lavender stuffed teddy bears. That
Mm.
sort of equation, the economics just don't make sense for as many Chinese people anymore. And I think it's tied up with deflation, inflation, and the currency.
Mm. So, as part of the response, is a sort of doubling down on exports, and we talked a little bit about this in our past chats. One of the reasons for this, I think we sort of said, both think this is true, is because they don't really have any other choices. I mean, policy wise, um, doubling down on exports is the way, perhaps the only way, with the housing market being the way it is, which actually speaks to something that actually panned out to be quite true in your book, all the way. Um, but talk a little bit. But what the Chinese are doing now with the current surge of exports is a little bit different. You've posited, right? Could you talk a little bit about that, um, as well as the um, the housing market and the exchange rate? Well, those are two secondary subjects. We can circle back to that. But um, the export surge, how is that a response to the economic problems that China is facing now?
Yeah, I think it's worth saying, look, as you said a minute ago, they're relying on exports because they don't really have many other choices. And I'm sure people listening to this would go, yeah, yeah, but what about consumption? I mean, it's so weak. Why don't they do something to boost consumption? And these two issues are intrinsically linked because they are leaning so much into exports because they're not willing to boost consumption. And the reason is, I think, China's leaders have been talking about the need to, for consumption to play a greater role in the economy for a long time, and they continue to do it. I think the issue is, though, that when we hear them say that outside of China, we assume that they're talking about wealth redistribution efforts because at this point,
Talking
it
about
makes, oh,
wealth,
sorry, but wealth redistribution
wealth,
measures, right?
right, right.
Because we look at it and we're like, well, look, the only way people would reasonably be able to spend more is if money was put in their pocket. But that's not what Beijing is talking about. I mean, clearly, Chinese officials say all the time they do want to spend more money on public services and welfare. I mean, there is this idea that Xi Jinping doesn't like welfareism. Sure, he doesn't like people getting something for nothing, but he does talk a lot about the need to spend more on healthcare and on elder care and on childcare. And all these things, if China spent meaningfully more on, could reduce the emergency savings or the anticipatory savings of China's public.
Right,
They save
right.
less, they spend more. Ipso facto, you've got a more consumption-oriented economy. But they're not doing that, even though they say all the time that they'd like to. And the
Mm.
reason is they don't want to fund that expansion of welfare or of public services with debt. They say it all the time. They say we need to be able to spend more on these things, but within our means and within the
Right.
ability of the economy to support it. So we're in this strange position at the moment, sort of post, property decline, that tax revenue is incredibly weak. And so, even though China's authorities might have this incentive and goodwill, and genuinely would like to spend more on all this stuff that might put more money in people's pockets, the fiscal situation does not allow them to do it. They could borrow and reallocate that wealth, but the way that they see it is herein kind of lies the road to damnation, because once you start spending more on welfare, you can't back out. You do it this year, you got to do it next year, you got to do it the year before, and all of a sudden you're in a sort of a spiraling sort of debt trap, which they refer to as being Latin Americanization, because they look at
Mhm.
Argentina and Brazil in what, the 80s, 90s, 70s, and they sort of see that as kind of what tripped up those economies. And so that's the
Right.
first part. A consumption-led economy isn't really a solution. And
Right.
so what they're really left with, because they had an investment-led economy with the property sector, so that's not really an option anymore now that it's peaked, now that the population is shrinking, that leaves exports. And of course, the approach to exports this time is a little bit different as well, because what they envision, what they really want, isn't just an economy that is churning out low-end mass-produced goods. What they want is an economy that's producing significantly higher value goods. And the reason is, things that they've designed themselves, things that are the result of local innovation, because those sorts of things allow them to generate higher profits. And if you have more profitable firms with higher profit margins, that supports higher wages, which supports a bigger tax base. And it's that combination which sort of allows China to continue, Chinese living standards and wealth to continue converging with that of the United States and the EU, gives the state the resources to spend the things that they want. And so you've kind of got this razor focus on raising productivity through industrial upgrading and innovation. And what that's resulting in is this sort of massive expansion of industrial capacity, but the domestic Chinese public isn't able to consume it because domestic demand is so weak, and so it ends up flowing overseas. And so that's kind of where we are at the moment. It is a very specific vision of future Chinese growth has to come from productivity gains through innovation and industrial upgrading. But the only buyers available for the output of all that is overseas, not at home.
Right. And that's gonna and that is the structural weakness. That is the structural sort of contradiction I think rather that they're struggling with. Um, that so much of the dependence of that growth is on markets that are increasingly unwilling to take that boom. Um, and I know you finessed it in your arguments because we talked about how the type of exports that China is now focusing on actually may find its appeal in places where you might not expect. But it is that inability um, of people at home to buy it that also creates that problem with the fundamentals of social contract that there's a sort of myth that the Chinese government is a one party state is forever. But there is a sense of social contract there. It's interesting when you talked about this guy called Zhu Shanqing in um, which town was he? It
Ah,
wasn't
was
Tianjin, was it? It was
Hangzhou? It was outside of Hangzhou, I think.
yeah, this incredibly colorful character with blue suede shoes, as Dinny described in his book, and crystal champagne, which is unfortunately not for you, um, and something to do with white ducks. And there's this quote that he just threw out at you, which took down, which is that it is not just difficult to grow, it's difficult to survive in China. Was what he said to you. Um, in the light of, that anecdote and including it in your book and looking at the situation today, what does that what does that say, in light of your comments on competition in China, economic life in China, and that um I guess social contract is one way of putting it, uh, which in a way you sort of touched on when you talk about tax, that tax authority, because I think at the central and the local level, there's a tension that it just seems impossible to resolve. There's a whole bunch of issues in there, but I don't know whether there's a sensible way for you to tie it all together,
Yeah.
um, to address.
Yeah, well, let's
Two
start with
touches.
the competition question, and see if we
Yeah.
can tie it a little bit into exports because that guy you were talking about in particular, he was a textile manufacturer, specifically spinning yarn and then making fabric. And he was moving from Hangzhou and setting up a factory in South Carolina. And what I find really interesting about that particular industry is that traditionally industries like that, which we typically think of being as low end, at this point in China's economic cycle, they should be moving out of China. And that's one of the reasons he was moving to the United States in the first place, because spinning yarn isn't a particularly labor intensive industry, or it's becoming less and less labor intensive. In fact, these days in a lot of factories around the world, you don't really have people in the factories at all. Like, the entire process is automated, right down to sweeping the floors. You effectively have industrial Zumba, keeping the dust down. You just have people. I know in some factories in China, you just have people, riding around with iPads and Segways, making sure all the computers, all the machines are working properly. And so he was moving to the United States because um, he found that the cost of energy in the United States was cheaper, the cost of land in the United States was cheaper, the cost of cotton in some ways was cheaper because there was a quota system in China. You had to buy local cotton first before there could be imports, and it was just easier for him to sort of be closer both to the supply of cotton and close to the end user. And so he was moving to the United States because, sure, labor in the US was more expensive, but everything else kind of worked out cheaper. And it's a really interesting industry because Beijing has effectively said over the last few years that I think it was the head of the NDRC explicitly said there are no low end industries, there are just low end technologies. And so we're in this really strange moment where these industries, which would traditionally have moved overseas, either back to the United States for the reasons I outlined, but in labor intensive manufacturing, in East Asia, I know when I was at university, we in the 90s, we got taught the flying geese model of development, whereby, as a nation developed, lower end manufacturing would move somewhere else when, where the labor was cheaper and in order to maintain its cost advantage. And that's where China should be at the moment. And Beijing is explicitly saying, no, we're going to keep all of those industries. And the way that they're keeping them is with technology. So you have this, you have, engineers and designers and PhD higher up the value chain designing more advanced machinery to be able to keep these industries in China with far fewer workers. And so the classic example of this is manufacturing of cigarette lighters in a town called, I think it's called Shandong in Hunan province. Makes something like 90% of all lighters globally. And it was facing the same problem as this yarn manufacturer, I think starting in 2016. It's just wages were going up. They couldn't keep their employees, and they couldn't keep prices down at the low enough for what their international buyers were demanding of them. And so they started upgrading their production line. And I think they've been through something like 5 or 6 rounds of industrial upgrading over the past, what, decade or so. And so we're now at a moment where over that decade, you got some of the biggest producers employ, I think, 95% fewer people, and the cost of
95% fewer people.
Mhm. And the cost of manufacturing a lighter is 85% less. And so this is kind of what Beijing is striving for. It doesn't want to keep low-end industries to maintain labor does it's not a safety net for keeping people employed. If anything, maintaining lower end industries is to be able to provide a market for the higher end manufacture and design of capital goods, and also to be able to have the full production chain to be able to innovate along every sort of step in that process in a way that places like the United States lost because so much of their low end manufacturing has kind of moved overseas. And so you've got this we're in this very strange moment where the industries we've traditionally thought of as being low end and ripe to move out of China are mostly only moving out to get around trade restrictions because there has been movement to Southeast Asia. But in terms of this, putting aside trade restrictions, the economics of these industries are changing as China tries to make them more capital intensive, make them more profitable. And as I said, labor is declining. And this is where things kind of get really interesting. It kind of comes back to your question about the social contract. If you look at sort of the labor data over the last few years, the percentage of people, or the number of people employed in manufacturing, it fell a little bit, it rose a little bit. It's basically stable, even though we've had trends like what we're seeing in the manufacture of lighters. And that's because China is expanding into more, advanced industries as well. But to the extent that Beijing has kind of a labor solution or has a vision for how this process will result in more jobs. It's focused not on manufacturing jobs, even though it's focused on manufacturing expansion, it's focused not on manufacturing jobs, but on white collar jobs. And you see this come up in the 5 year plan. You can see it, I think, also in the work report, is that what they want is the generation of white collar jobs providing business services to the industrial sector. And a great example is you take a company like Apple, right? Apple employs 90,000 people in the United States and employs none of them in manufacturing. Apple doesn't make anything in the US, but
Hmm.
most of those 90,000 people have relatively high paying white collar jobs. They're designers, they're software engineers, they're PhDs, they're supply chain managers, lawyers protecting IP, and that's what China wants for its economy. Any high-end manufacturing firm which has robust profit margins is in a position to spend a lot more on advanced business, white collar business services, and
Hmm.
that's the vision, and that is kind of really important because you see these tens of millions of kids graduating from university each year, and at the moment they come out and the jobs they were promised or the jobs they think they were promised don't exist, but they might if if this happens. Now, of course, AI might throw all this, throw a spanner in the work with all this, but that's a different story. But yeah, that kind of speaks to the social contract, the
Hmm.
low end manufacturing, what it means for exports. So yeah, a lot going on there. But
Yeah. Yeah. What's the read on China now? I mean, what you've described sounds like it's riddled with really quite high risks. Um, what's your read on China now? I look at a 55-year plan and all I see is robotics, 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 right? I mean, I think the term AI appears like 15 times. I'm sorry, 50, more than 50 times. Uh, what's your read on China, both as an analyst and in light of all your experiences?
It's tough because you're right. I mean, they are so razor focused on tech and innovation and industrial upgrading. That is the future as far as they're concerned. And I think one of the reasons they're so focused on that is because they're overtly aware that demographics are not in their favor.
Yeah.
They're dealing with a shrinking domestic population. The only way you're going to be able to uh, raise incomes in an environment where fewer workers are supporting a much larger population of retirees. I mean, ultimately, what they want is to be able to raise everyone's income so it becomes a more affluent nation. But that's incredibly difficult when your working age population is there's fewer and fewer workers supporting more and more retirees. Ultimately, you need a system that allows you to be able to tax the workers more, and yet they still feel better off. So their incomes have to be going up, even as the state is sort of extracting more and more out of them. And I think in some ways that's why, at least from an economic perspective rather than a securities perspective, but I think from an economic perspective, that's why they're so focused on tech and innovation, because they see that as the only way out of the middle income trap, the only way to keep raising wealth and incomes, even as demographics move against them. So that's my take on what they're trying to achieve. But of
Mm,
course, there's sort of layers of complexity here because domestic, you've had people, so much of making that a success relies on the rest of the world buying more and more, not maintaining levels of consumption, but the rest of the world buying more and more of what China produces. And given that, back in the day, back when we were journalists, I mean, there was the argument that, look, China has a massive trade surplus, but it'll eventually work itself out, because you kind of get to a point where the economy will restructure. The rest of the world can only absorb so many exports from China, and then it'll restructure into something that looks like more like an advanced economy. And it seemed mind-blowing to think that an economy the size of China could pivot and start to extract further growth from exports. And that's what happened last year. I mean, I think a third of China's growth came as a result of exports, which is mind-blowing for an economy the size of China. And
yeah.
so it is so dependent on the rest of the world buying its stuff, which
Mm,
is both it's a vulnerability, but it's kind of sort of baked into the system at the moment. And then meanwhile, as I said, domestically, they're not willing to redistribute wealth by using debt, and there don't really seem to be many other options available to them. So they're kind of waiting for the housing market to bottom, at which point maybe home prices will start going up again. They're very invested in trying to revive the stock market, but this time, rather than sort of manipulating it in the way that Beijing has traditionally done, it's a lot
mm,
more about sort of building a foundation of trust and sustainability, and hopefully that will be an engine of middle class growth. But then at the same time, you have this sort of massive debt overhang at a local government level. Beijing is refusing to bail out local governments, and so
mm,
this was you've effectively got austerity policies at a local government level, which is
yeah.
effectively continuing to drag on growth. So you've got all these sort of challenges. You've got the debt, you've got demographics working against them, you've got the problems of the property market, and then you've got this razor focus on the future of Chinese prosperity can only be delivered by innovation and industrial upgrading and productivity. I mean, it's. I'll make one other comment before you sort of move on. For this vision of industrial upgrading and productivity and innovation to be a success along the terms that I just described, all right, that it will deliver a more prosperous China, three things have to happen.
Mm,
It needs to result in more profitable companies, companies with higher profit margins. It needs to generate higher paying jobs, all right? And it needs to expand China's tax base. It doesn't need to generate more tax revenue. It needs to generate more tax revenue relative to the size of the Chinese economy. And last year, none of those happened, all right? First half of last year, tax revenue actually fell, which is mind blowing to think taxes contracted in a year that the economy was nominally growing at 5%. I mean, full year it went up 0.8%, but there's reasons for that. But an economy is growing at 5%, and yet
yeah.
tax revenue is barely moving at all. Corporate profits, exactly the same thing. Corporate profitability, I think, increased 0.6, 0.8%. We don't have the same measures for incomes, but I mean, you spend any time in China and people talk about how they're worried about their own wealth, because of the property market. Everybody knows somebody who's either lost their job or more often than not had to take some sort of pay cut or they didn't get their bonus or something. And so, you know, sitting outside of China, we see this economy that's going absolutely gangbusters in terms of selling
Sure.
abroad more innovative products, solar power, solar panels and, electric cars and, on the horizon, there are flying cars and it looks like, wow, China's delivering the future. And yet domestically, no one's actually really experiencing the benefits of all that because that model isn't delivering what it's supposed to yet. Now, the question is whether it can or not. And I think that's the tension. They've got a vision of what the economy needs to look like, but at the moment it's not paying off.
Yeah. Yeah, that point on tax is fascinating, and I don't understand why it hasn't gone up. Just to sort of explain maybe. The fiscal structure in China, and maybe Dinny, you can do a better job at this than I can, is has a real tension between central and local because a lot of what the localities raise, they have to give to the central government, and therefore leaves the localities with very little tax base, and they used to depend on land and debt, the issuance of debt as a way to fund themselves, which ended up in uh, the debt problems that Dinny writes about a lot in his book. Um, One thing we had a question here asking from reader, can we have a summary of the book, which I think you sort of addressed at the start and the takeaways, which this talk is all about. But maybe what did you suggested this question to me yourself. What do you feel you got wrong in the book?
Yeah, so I think one of the great challenges when I was writing this thing was to kind of come up with conclusions because, as I said, it was as much as anything, it was a cathartic experience. It was like pulling the threads together, trying to explain what I saw. And I was left with the question of what comes next, I was kind of scratching my head a little bit. I mean, in hindsight, what I realized I was writing about was kind of the final days of China's last growth model. Now, it's funny, as he said, that the title of the book is the China's Great Wall of Debt, but the tagline was Shadow
Shadow,
Banks, Ghost Cities, Massive Loans, and the End of the Chinese Miracle.
right.
And I
I think you've
remember
got
getting a
shadow
question at
banking,
some
those
point,
cities, and
massive
and
loans.
right. Okay.
And I remember getting a question at some point. Someone asked me, "So when do you think the miracle is going to end?" And I'm like, "Oh, it's not a prediction. It's a statement of fact. The miracle is already over. What we're witnessing are the dying days of the Chinese economic miracle." And it's funny because I do look back on it now and it's like, oh, yeah, that's exactly what was happening. This was the last days of a completely unsustainable economic model, which had been in the early days was sheer genius. I mean, to leverage the demand of the public for housing and for new infrastructure, bringing urbanization, bringing people from the cities. I mean, it was an incredible motor of growth. But by the
Yeah.
time you got to 2016, 17, 18, I mean, it was all over but for the screaming. And the screaming finally started in 2020, 2021 when they pulled the plug on the property sector. And all of a sudden, it became clear it wasn't sustainable. But I'd say that one thing I got wrong was one of the few predictions I made was in my chapter about the financial system. I was like, look, this thing has to end in tears. I don't know when it's going to happen, but at some point there needs to be a financial crisis. Because what I was looking at the time was, Beijing had completely lost all control over the financial system. I mean, every time regulators rolled out some rule to rein in shadow banking, the system just immediately slipped into gear to come up with a workaround. I mean, I remember at the time talking to a guy who was designing wealth management products at one of China's big banks, and he was like, "Oh yeah, we've got three or four different alternative versions alternative ways we can structure these products. So if they ban this one, we're ready to go the next day with a workaround." And that was the system, right? Everybody was complying with the letter of the law, but everyone, the financial system was also flouting the spirit. And I think what I didn't anticipate was two things. Firstly, I just thought that the complexity would get worse and worse, and it would result in a crisis. What I didn't anticipate was when Xi Jinping's anti-corruption campaign came knocking for the financial system. And what happened then is that idea of, complying with the letter and flouting the spirit, that got flipped on its head. It then became less important to be complying with the letter of the law. What became important was to complying with the spirit of what was being asked of you. And if you weren't complying with risk control efforts, then you were potentially on the out and you were sort of exposing yourself. And so, very quickly, starting in about 2016, 2017, they managed to rein in financial risk in China's financial system very quickly, very effectively, to today, where I mean, you look at China's financial system and it's more or less relatively safe. We don't look at it and go, oh, there's going to be a financial crisis. If anything, the regulators seem to be incredibly on top of the situation. Now,
Yeah.
what we didn't
Neither does the
anticipate.
IMF, by the way. Think that it's near a crisis. But go on. Sorry.
So, what we ended up with instead of a financial crisis, and it was something no one was talking about, but it's the obvious corollary, right? If you can't pay, if you can't meet your financial obligations, if you can't repay a bond or pay the interest on the bond, you either default, and ultimately if it's the wrong sort of debt, that potentially ends up can trigger a financial crisis, or you pursue austerity policies. You rein in your spending elsewhere so that you can pay the interest on the debt. And that's what the UK did, and that's what Greece did. But we never assumed that would be something that would happen in China. And yet that's what happened in China, except it wasn't imposed top down by Beijing. It was the response of local governments to their own financial stress. And that's
Mm,
what we've had over the last few years. And it's been a drag on the economy, both on household sentiment and on business sentiment. And it's just been sucking money out of the economy because local governments are under pressure to make sure they don't default. There have been defaults. There have been defaults on shadow banks and various other stuff. But the important defaults on the bond market, the
mm,
local governments have always ensured that they always meet those obligations. Um, and so to make sure the money's always there, even as Beijing asks them to spend more on science and technology and more on education, the only way local governments have been able to do that in a world where they're not making the same money from land related taxes or land revenue is that they have to cut back elsewhere. And so they've been racking up arrears. They haven't been paying their suppliers and contractors.
mm,
State employees across the country have been subject to pay cuts.
mm,
Local authorities have gone after back taxes, both real and imagined. I mean, it is real austerity. And that has been the consequence. And it's something that I didn't have the imagination to foresee. And yet that's what we ended up with. We didn't get a crisis, but we got austerity. And that's one of the things that's dragging on domestic demand.
mm. Well, in a way, you did talk about how China's banking system, in the book and in more recent conversations, it's not really built for the private sector. I mean, it's built for SOEs. You address that in the book in detail. Do you still believe that to be the case? Number one, and then in the book you also talked about, I can't remember whether it was Shi and Hubei where Dongfeng is, or was it
Mm.
Tianling, where the Chinese system does not like the idea of bankrupting companies, of companies going bankrupt, and they would rather fold them into another company and just tough it out. And is that something that still persists today? One of these incredible quotes that you had from the book was Beijing has unleashed a perpetual debt machine over which it has lost control. Well, you've explained might have changed, but those two things, is China's banking system still not for the private sector? And secondly, uh, the way it treats failing companies.
Yeah. Oh, geez. Chiun, we could talk about this stuff all night.
I know.
Um,
I mean, we
okay.
kind of do sometimes.
Yeah, right. Um, okay. How does the banking system does it still is it still really about the state sector? I haven't done work on this, but I know other people have to say, look, the banks these days provide far more credit to the private sector than they ever have done before, right? But um, I've been doing some work with a private credit fund for the last few years, and they say, look, yeah, the banks lend more to the private sector, but it doesn't even scratch it doesn't even scratch the surface. The degree to which the private sector requires credit is not being met by the banking system. Sure, the banks lend more, but it falls far short of the needs of the real economy. The second thing to keep in mind is that the way that regulators and government advisors talk about this is that they say, look, the banking sector is they don't say that it doesn't serve the private sector, but what they do say is that it is not fit to meet the needs of this new economy as envisioned by Xi Jinping. Right? This new economy being something led by innovation and industrial upgrading and productivity, because most of those gains are going to come from the private sector. And the banks aren't geared towards lending to firms that are, you know, asset light, that might not be generating a profit yet, that might have great ideas but don't have a track record. I mean, ultimately, this is the problem of a financial system everywhere. The banking system is not well, positioned to support these firms, which is why Silicon Valley exists. It's why the Nasdaq exists. Um, you've got all this ecosystem of venture capital to kind of help tech startups in California and elsewhere in the United States. So the US has that alternative financial system outside of the banks to be able to support that side of the economy. And Beijing is desperately trying to build that out at the moment in China. Now, in terms of dealing with zombie companies, do they still get absorbed elsewhere? Yeah. I mean, M&A is part of the strategy for Beijing's anti-involution campaign. The NDRC just announced that they're launching an M&A fund. It's going to be leveraged. It'll be able to be leveraged up to support a trillion renminbi's worth of deals, is what they said. Now, I originally saw that, and I'm like, oh, this is about supporting venture capital. It's about supporting innovative new firms by
Mm.
allowing larger firms to come in and buy them, so that it's an exit without doing an IPO. But the more I read, the more I realize actually no, this is probably just as much to do with dealing with overcapacity. It's a way of consolidating industries. So yeah, it is still very much it's still sort of very much part of that approach. Um, I think the last thing that's worth talking about is you sort of mentioned the perpetual debt machine. And it's funny because what I described in the book as a perpetual debt machine, that doesn't exist anymore. And yet, even despite these efforts to rein in debt and have a new driver of economic growth, you look at debt levels in China at the moment, and the pace of debt growth every year, the pace at which debt is expanding, is still twice the pace of economic growth, or it's at least nominal economic growth. So what
Right.
nominal economic growth was, what, 3.5, 3.8% last year. Debt, the amount of total social financing, so more or less debt, grew at about 8% last year. It's not shadow banking anymore. So much of it's not households borrowing for mortgages. So much of this debt is state led, but still the debt to GDP ratio just keeps going up and up and up, in part because that's the only way that they're still managing to maintain these growth levels.
And when you say state-led, do you mean a corporate state or state?
It's mainly state. So it is local. It's
Local governments.
local government, special purpose bonds, special
Right.
treasury bonds, policy bank lending to local governments. It's that sort of stuff.
Right. Right. I would imagine, you talked about the transfer of bad loans from Tianling to CDB.
Mm.
Uh, I'm pretty sure some of that still exists. I mean, that relationship.
I'd imagine so, but it's pretty opaque to be able to
Mm.
hunt that down and get a real insight into what's
Yeah,
going
yeah,
on these days.
yeah. I wanted to squeeze in and you talked about its interactions with the US, obviously, with and you're at Trivium. What do you tell people when you talk about the investability of China these days? And uh, sorry, I like to double barrel my questions, which I should. But what does it say about China's uh, collision or its contest with the United States and its place? By PPP is the largest economy in the world, in some ways unavoidable. What does it say about its place in global geopolitics? Let's
Yeah,
start
the whole
with
question of
investability. Yeah,
Yeah, the whole question of what do you tell people about whether China's investable? To be honest, other people will tell us whether whether they think China is investable or not. But certainly, depending on who you are, that narrative has changed. I mean, for investors, for a period of about 3 years, that was the narrative. China's uninvestable. Um, and that's as soon as asset prices start going up, oh, China's not uninvestable anymore. It's amazing when there's money to be made, how quickly will change that people will change their tune. Although the stock markets in particular are quite interesting because traditionally Beijing, when it wanted prices to go up, it kind of had a toolkit of things that it would do to try and get prices to rise. It would start by planning a story in, say, the Economic Observer or something, saying, an anonymous op-ed or something saying A shares are undervalued, and people would sort of see the signal and go, "Oh, support's coming," and it may or may not result in prices going up. Valuations going up, and then they'd mobilize the national team to buy stocks. They'd make it harder to short sell. They'd have a moratorium on IPOs so that they didn't dilute the amount of money going to stocks. There was just tick 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 tick. There was a list of things they would do, and I think the last time they tried it was the second half of 2023, and it just didn't work anymore. It just none of it worked. The market had wasn't paying attention, and so since the beginning of 2024, they've been taking a different approach. And what they're trying to do is lay the foundations for a more sustainable. What they want is what they call a slow bull market, right? They want what developed markets have, where the market just over times, if you zoom out, the market just curves up and to the right, which is not what China has. China has it goes flat for a decade, it peaks, has a bubble bursts, and then it moves sideways again for a decade, and then rinse and repeat. And so they want a slow bull market. They want what the United States has. And so they're doing four things. The first thing is they're trying to build public trust in the market, and which I mean the Chinese public does not trust the stock market. I mean, there's a general perception that the only
yeah,
way to make market in the
yeah.
system is if you have an inside track. Insiders are the only ones who make money, and so has been this full court press for the last 2 years of just trying to do everything to rebuild trust. Go after rule breakers more aggressively, increase the penalties for fraud, increase the penalties for poor audits, reducing the fees that securities firms and mutual funds, charge. Even something from like ripping out the servers that algorithmic traders, high frequency traders had in the stock markets to kind of show, look, we're not; these people aren't going to have an advantage anymore. They're just like you and me. So a million and one different sort of measures to try and level the playing field and rebuild public trust in the markets. The second thing they're trying to do is ensure that people who invest get a return even if the market's not going up. And so they've been pushing listed companies to issue at least one dividend, ideally two each year. The PBOC has a special facility to fund share buybacks. So there's that. The third thing they're trying to do is inject a degree of, have what they call patient capital playing a greater role. So some branch of government did some research and they found that, when the bubble bursts in China, the lows are lower and they stay lower for longer than in developed markets. And the reason is because retail investors play a disproportionate role in China's stock markets. And so what they need is pension funds, insurers, just
Mm,
long-term sovereign wealth funds playing a greater role to kind of stabilize the market. And the fourth thing they're trying to do is just really have exciting IPOs, hard tech IPOs that people can kind of get excited about. So that's the vision. So this kind of comes back to, what do you tell people about whether China is investable? I don't know, but they're
mm,
trying something radically different from the way that they've managed the markets in the past. That they
mm.
want something that they want a market which they want a slow bull market because, you know, they want a new engine for middle class growth to replace the property sector. They have a rapidly aging population, and so they need a way for people to top up their retirement savings. They need a mechanism to fund innovative firms, and something that we don't talk about that often, but it's a way to kind of support renminbi internationalization because it
Yeah,
creates a renminbi
the market
denominated
access.
asset
Yeah,
class.
yeah.
Yeah, that the rest of the world wants to invest in. So there's a lot of reasons for doing this. Whether it'll work or not, that's way above my pay grade, but it speaks to the
Good.
investability argument. They're trying something different and something that's a lot more appealing to the rest of the world.
Yeah. In a way, as we bump up against time, everything that you just said, in a way, sort of very nicely loops back to Bobby, the lavender stuffed teddy bears, because that was about consumer safety, right?
Yeah.
That was about the Chinese consumers' desire. I mean, to put it in an understated way, to know that something is safe, uh, and secure for them, which is everything that you just talked about. People want that assurance from China. Um, I don't know if you have any last words to add as we head into the close of the hour. Um, did any any sort of final comment or
Yeah, I mean, just circling back to the book again, I hadn't fully appreciated at the time that I was writing a bookend to a particular era in China's economic history. But at the same time, so much of what's in there as well is kind of like foundational for understanding what's going on as well. It's not like that there was a hard break and all of a sudden we're doing something radically different. But
yeah,
yeah, when I was sitting there kind of looking at the end of the Chinese miracle, I think there was an awareness that something had to replace it. But back then, it wasn't immediately obvious what it would be. I mean, we had this narrative that one day China would pivot to being a consumption-led economy. It has unambiguously rejected that road. And instead, we have this experiment which requires the rest of the world to buy Chinese industrial goods in ever increasing volumes. And the question is, does that break at some point? And does it break at a point prior to China having been able to extract what it needs out of there and perhaps sort of have, restructured domestically in a way that it can generate domestic demand to a degree that it doesn't need the rest of the world as much as it used to? That's kind of the question, I think, at the moment, because that's ultimately what it needs to do, but it's not clear whether it's going to be able to pull it off.
yeah. Well, I smell a sequel. So I do. So
Don't let my wife hear you say that.
well, give my regards today,
I will.
and thank you so much for being with us today, Dinny. It's been such a pleasure. This it feels like this chat should have been a long time coming. But thank you so much. It's been a great pleasure just walking back through history with you and the current.
Likewise, Chunwei. It's just great to being able to talk to you about this stuff.
Yeah,
It's
no,
as you said, it would
likewise.
have, yeah, long time coming.
Yeah. Well, thank you, Dinny. And thank you, everyone. This is the Dinny McMahon, Trivium, and former Wall Street Journal colleague. Thanks for joining us this morning.